Hey guys, welcome back to the Bitcoin Fortress podcast, building one block at a time. Today is May 3rd, 2026. We are at block height 947751. Moscow time is 1269 sats per dollar, and fees are still beautifully low at 1, 1, and 2. This week felt like one of those Bitcoin weeks where everything came together. The Bitcoin 2026 conference in Las Vegas, institutional adoption, regulatory signaling, self-custody Bitcoin-backed credit, merchant adoption, and the ongoing question of whether Bitcoin is being financialized or whether traditional finance is slowly being Bitcoinized. And that ties perfectly into this week's featured Substack post, Bitcoin versus Monetary Architecture, the emergence of hard digital money. The whole theme is simple. Fiat money is architecture built around discretion, debt, committees, and emergency expansion. Bitcoin is architecture built around rules, verification, scarcity, and time. So with that, let's get into it. First up, Bitcoin Conference 2026. Vegas becomes the center of the Bitcoin world. Bitcoin 2026 took place April 27th through the 29th at the Venetian in Las Vegas, with the official conference site describing it as the world's largest Bitcoin gathering and highlighting tracks for open source, institutions, policy, builders, and adoption. The speaker list included Michael Saylor, Jack Mallers, Senator Cynthia Lummis, SEC Chair Paul Atkins, CFTC Chair Mike Seelig, Jack Dorsey, David Marcus, Paolo Ardino, Eric Trump, and many others. The big story here is not just conference hype. The bigger story is that Bitcoin now has multiple parallel constituencies: cypherpunks, corporations, politicians, banks, payment companies, miners, open source developers, and everyday plebs just like us. That creates tension, but it also shows how far Bitcoin has come. Bitcoin started as money outside the system. Now the system is being forced to respond to it. At Bitcoin 2026, SEC Chair Paul Atkins and CFTC Chair Mike Selig reportedly emphasized a regulatory reset focused on keeping crypto development onshore instead of pushing it overseas. For Bitcoiners, the key distinction is this: regulatory clarity can be useful, but Bitcoin does not depend on regulatory permission. Bitcoin works because nodes verify rules, miners secure blocks, and users can self-custody. Still, clear rules may reduce the chilling effect on companies building wallets, exchanges, lightning tools, and custody infrastructure. Bitcoin Magazine reported that Trump administration officials at Bitcoin 2026 discussed a DOJ and FBI shift toward targeting criminal activity rather than developers building neutral technology. How about that? Chase down the bad guys instead of criminalizing the guys that are just trying to keep our lives from the front page. This matters because privacy tools, self-custody tools, and open source software have been under pressure. Bitcoiners should welcome any movement away from criminalizing developers. Writing code is speech. Building privacy tools is not money laundering. The line should be drawn at actual criminal conduct, not the mere existence of tools that preserve financial freedom. A Bitcoin 2026 panel featuring Joe Kelly, Nick Begich, and Zach Herbert argued that Bitcoin self-custody should be recognized as a civil liberty. This may be the most important philosophical point of the week. If you cannot hold your own money, you do not really own it. Self-custody is not a technical preference. It is the foundation of Bitcoin's freedom proposition. ETFs are fine, exchanges are useful, but self-custody is where Bitcoin becomes sovereign money. Moving along to adoption, payments, and Bitcoin financial products. Bitcoin Magazine reported that Block plan to demonstrate Bitcoin payments through Square using NFC tap-to-pay technology, while also discussing BitKey, Cash App, and Block's broader Bitcoin ecosystem. This is the quiet adoption story that matters. Not number go up, but can normal people use Bitcoin without friction? If Square can make Bitcoin payments feel like tapping a card, that starts to close the gap between Bitcoin as pristine savings technology and Bitcoin as usable money. Block published Q1 2026 proof of reserves information showing total Bitcoin holdings of about $2.2 billion. Proof of reserves should become a cultural norm. Bitcoin is about verification. Companies that build on Bitcoin should embrace transparency. The more companies prove reserves cryptographically or publicly, the more Bitcoins don't trust verify ethos migrates into corporate behavior. Jack Mallers used Bitcoin 2026 to announce a product update and strategic moves for Strike, including Bitcoin credit-related developments. Bitcoin-backed credit is one of the big themes of this cycle. Long-term holders do not want to sell the best collateral on earth. They want to borrow against it carefully. The opportunity is huge, but the risks are real. Rehypothecation, margin calls, counterparty failure, and regulatory risk. Bitcoin-backed loans are powerful tools, but they must be used conservatively. Aven unveiled a Bitcoin Visa card at Bitcoin 2026, offering a credit line secured by Bitcoin collateral. This is another sign that Bitcoin is becoming financial collateral. That is bullish, but it also creates temptation. The Bitcoiner's rule should be borrowing against Bitcoin may make sense in limited situations, but never risk your long-term stack for short-term consumption. Don't lose pristine collateral because you wanted fiat lifestyle upgrades. And of course, at some point, you're going to have to pay it back. Bitcoin Magazine reported that executives from Salt Lending and People's Reserve argued at Bitcoin 2026 that Bitcoin-backed loans are emerging as a path toward home ownership. This hits home for many Bitcoiners, no pun intended. The traditional system forces people to sell assets, take taxable gains, or beg banks for permission. Bitcoin collateral changes that equation, but again, the key is responsible structure, low loan to value, no rehypothecation if possible, clear margin rules, and a plan to survive volatility. Stake and Shake executive Michael Bowes said at Bitcoin 2026 that Bitcoin payments reduced processing costs by 50% and saved the company millions annually. This is the merchant story Bitcoiners have been waiting for. Credit card fees are a tax on commerce. Bitcoin and Lightning can reduce that toll, even if consumers still mostly save Bitcoin. Merchants now have a reason to care. Lower fees, faster settlement, and less dependence on payment processors. Moving right along to Bitcoin infrastructure, open source, and banking rails. Mara announced the Mara Foundation at Bitcoin 2026 to support Bitcoin development and related initiatives. Open source funding is not charity. It is infrastructure maintenance. Bitcoin secures trillions of dollars in value, yet much of the code base depends on underfunded developers. If miners, exchanges, custodians, ETF issuers, and treasury companies benefit from Bitcoin, they should help fund the commons. Galoy unveiled an expanded version of its Bitcoin native core banking platform, aiming to help banks and financial institutions integrate Bitcoin into their product stack. This is where Bitcoin starts eating banking infrastructure from the inside. The future may not be banks disappearing overnight. It may be banks becoming Bitcoin service layers, accounts, payments, custody, lending, and remittances built around a harder monetary base. Paystand announced USDB at Bitcoin Las Vegas, positioning it as an infrastructure for large-scale business-to-business payments. This one deserves a careful Bitcoin-only lens. Stablecoins are not Bitcoin. They are tokenized fiat. But if stablecoins move onto Bitcoin layers, that shows Bitcoin is becoming settlement infrastructure. The risk is that dollar tokens become surveillance rails. The opportunity is that Bitcoin layers become the neutral foundation for global payments. Moving right along to treasury companies, ETFs, and market structure. CoinDesk reported that Strategy purchased 3,273 Bitcoin for about 255 million, bringing total holdings to 818,334 Bitcoin as of April 26, 2026. Strategy remains the corporate Bitcoin treasury story, whether critics like the leverage or not. Saylor has created a new corporate finance playbook: issue fiat liabilities, acquire scarce digital collateral, and let time expose the weakness of fiat-denominated balance sheets. Bitcoin.com reported the Strategy then skipped a weekly Bitcoin buy after 108 total purchases, leaving its holdings at 818,334 Bitcoin and shifting market attention to leverage, reserves, volatility, and future buy signals. This is a reminder that even the biggest corporate buyer is not Bitcoin itself. Bitcoin does not depend on Strategy, BlackRock, or any single institution. The network continues block after block. Institutions can amplify adoption, but Bitcoin's strength is that no company controls it. Economic Times reported Bitcoin trading near 78,000 with roughly 1.9 billion in ETF inflows, signaling strong institutional demand. ETF flows are the bridge between traditional finance and Bitcoin scarcity. Every share purchased represents demand for exposure to an asset with a fixed supply. The ETF wrapper may be Wall Street, but the underlying asset is still Bitcoin, and that is asymmetry. Cointelegraph reported that Bitcoin finished April with an 11.87% monthly return, its strongest monthly performance in 12 months. Price, of course, is not the thesis, but price is the messenger. After a choppy start to the year, April reminded everyone that Bitcoin can reprice quickly when liquidity, ETF flows, and sentiment line up slowly and then suddenly. Moving along to mining, AI, and the changing industrial layer. Investors Business Daily reported that Riot's Q1 revenue beat expectations, while AMD exercised an option to double its data center capacity with Riot to 50 megawatts. Bitcoin mining revenue fell, but data center revenue became a new growth pillar. This is the mining story of 2026. Miners are no longer just miners. They are energy companies, data center companies, AI infrastructure companies, and Bitcoin treasury companies. That can strengthen their balance sheets, but also raises a question. Will public miners remain Bitcoin aligned, or will AI economics pull them away? And of course, the difficulty adjustment will continue to make things interesting as miners unplug. New miners will want to earn those sats. So that's the beautiful thing about the protocol. Blockspace observed that several public miners sponsored Bitcoin 2026, but some major AI-oriented miner hybrids were absent, suggesting mining companies may increasingly divide attention between Bitcoin and AI events. This is worth watching. Bitcoin mining has always been about finding the cheapest energy and monetizing it. AI data centers are now competing for similar power infrastructure. The companies that survive may be those that can flex between Bitcoin mining, high-performance computing, and energy arbitrage. Now let's take a look at policy and politics. At Bitcoin 2026, 3 Republican members of Congress reportedly framed Bitcoin and crypto regulation as a national security and economic competitiveness issue, arguing that U.S. weakness could benefit China. This is where Bitcoin enters geopolitical strategy. Nations are starting to understand that Bitcoin is not just an asset, it is monetary infrastructure. The question is whether the US embraces open monetary innovation or tries to protect the old system until the old system breaks. Barron's reported that Senators Tom Tillis and Angela Alsobrooks reached a bipartisan compromise on stablecoin yield rules, removing an obstacle to broader crypto legislation. Stablecoin regulation matters because stablecoins are the bridge between fiat and digital rails. But from a Bitcoin perspective, stablecoins are not the destination. They are digital dollars. Bitcoin is the exit from discretionary monetary architecture. Now let's take a look at the Bitcoin podcast universe themes. Theme 1, of course, Bitcoin 2026 dominated the conversation. The Jack Mallers Show released Mailbag Monday live from the Bitcoin conference on April 28th, recorded from the conference environment. Bitcoin Today also published a Vegas recap on April 30th, describing reflections from attendees coming back from the conference. The podcast universe was clearly centered on Vegas, the energy, the announcements, the institutional crowd, and the tension between Bitcoin culture and mainstream adoption. Second theme, open source funding is becoming a major issue. Stefan Livera's latest listed episode, SLP 734, with Pavlinex, focused on why funding open source is not philanthropy but strategically important to the Bitcoin ecosystem. This connects directly to Mara's foundation announcement, Bitcoin's commons need funding. If the world is going to depend on Bitcoin, then Bitcoin development cannot be treated as an afterthought. Third theme, the conference keynotes became podcast content. Bitcoin Magazine posted major Bitcoin 2026 talks on YouTube, including Jack Mallers' keynote, The Bitcoin Company, Jack Dorsey's What is the Price of Freedom, and Michael Saylor's keynote. The week's Bitcoin podcast universe was less about normal interviews and more about the conference becoming the main topic of conversation. And of course, Saylor, Mallers, Dorsey, and the policy panels gave everybody plenty to chew on. Next, wanted to talk about this week's featured Substack post. This week's featured post is Bitcoin versus Monetary Architecture, the Emergence of Hard Digital Money. The core idea is that money is not just a tool, it is architecture. Fiat architecture is built around central banks, fiscal deficits, emergency interventions, debt expansion, and trust in institutions. Bitcoin's architecture is different. It does not expand because a committee votes. It does not respond to recessions. It does not monetize deficits. It simply follows its rules. That is why this week's news matters. Every story we covered points back to architecture. Bitcoin-backed lending is new credit architecture. Lightning payments are new merchant architecture. Self-custody is new ownership architecture. Open source funding is new infrastructure architecture. ETFs are traditional finance adapting to Bitcoin's architecture, and regulatory clarity is the old system trying to understand the new one. The old system asks, who's in charge? Bitcoin answers, the rules are in charge. Before we wrap this week, a quick reminder that there are now 4 Bitcoin Fortress books available on Amazon. Bitcoin Fortress, a simple guide to Bitcoin for beginners. Bitcoin, Retirement and Estate Planning, The Bitcoin Lifestyle, and the newest one, which I just published last week. Super excited about this one, The Architecture of Money. This new book ties directly into the themes we've been covering in my 2026 essay arc, Fiat Money, Debt Liquidity, Debasement, Monetary Trust, and Why Bitcoin Represents a Fundamentally Different System. So check that out. Links in the show notes to those as well as all the articles that we covered this week. And that is a wrap for episode 214 of the Bitcoin Fortress podcast. This week, Las Vegas gave us the spectacle, but the real story was deeper than the conference. Bitcoin is moving into payments, banking, credit, public companies, policy, mining, open source development, and merchant adoption. But through all of it, the core remains the same. 21 million, self-custody, verification, low fees, open source code, blocks every 10 minutes, rules without rulers. The world is slowly discovering that Bitcoin is not just another asset. It is a new monetary architecture. Stay humble, stack sats, and keep building your Bitcoin fortress. And I will talk to y'all next week. Bye-bye.